While Starbucks has been finding it difficult to demonstrate growth, Dutch Bros has been growing rapidly in recent years. But what about for investors? Should investors buy Dutch Bros stock for 2025? I'm going to answer that question in this video, evaluating the company's revenue growth, looking at their profit, their cash flow, and then looking ahead. What does Wall Street expect from Dutch Bros over the next 5 years? And then comparing it all against its valuation to answer whether or not I think this makes sense for long-term investors here in 2025. Let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I mentioned the company's demonstrated phenomenal revenue growth, $1.2 billion in trailing 12-month revenue. That's up from around $400 million in 2021. They've roughly tripled their revenue in the last couple of years in an industry that hasn't experienced this kind of growth. Overall, the total addressable market for coffee is around $400 billion, and that hasn't changed by all that much in these recent years. So what's happening? Dutch Bros is taking market share from companies like Starbucks that, I'll admit, have fumbled recently. Starbucks has fumbled, and their performance hasn't been strong. I shouldn't say easy, but they found it difficult to execute on the business. Maybe you noticed this too, but oftentimes I open the Starbucks app and I'm looking for a certain drink and it's sold out in the location that's closest to me. And that happens so often that it's become a theme now where I'm surprised if they have the drink I'm looking for. And that's executing your business model and disappointing investors. Those kinds of errors led to the company searching for and stealing away a CEO to try and fix things. But so far, they're still not recovering. And that's giving an opportunity for a company like Dutch Bros to step in and take market share, and they have. More impressively than the company's revenue growth is the profitability. They're already profitable at 7.8% operating profit margin, and they're still growing rapidly. A company like this that's still in the early growth stages of the business, I would be willing to accept a moderate loss on the bottom line for several years before they became profitable. But not this company. It's already profitable and expanding quickly. The operating margins jumping from negative 25 all the way up to 8% shows great business execution, profitable growth, not just going after growth at all cost. An even better story, if you look at the cash flow from operations to sales, it's all the way up to 19%. The company's been consistently positive in cash flow from operations. That's important for a growth business because the cash flow is where the business really becomes self-sustaining. This is where it becomes a sustainable business. As long as it can generate cash flows, it can stay in business. And if it generates this strong, a 20% cash flow from operations, that's even enough to fund growth, to fund considerable growth. So they don't need to go to investors and ask for more money to fund their growth, but they could. And they could get favorable terms from investors because it's such a solid business on such solid footing that lenders and equity investors would be willing to give the company money at reasonable interest rates because they've already demonstrated that they can operate this business profitably and not just try and demonstrate growth while losing significant sums of money on the bottom line. I've shared with you some of those type of companies. In fact, I've shared with you some of those companies to avoid because they're spending so much money trying to chase after growth that the business is not sustainable. That's not the case for Dutch Bros. In fact, it's far from the case. The company is well on its way to sustaining itself and generating enough cash flow to fund its growth opportunities. And the analysts on Wall Street that are following Dutch Bros stock, they expect the company's profits to continue increasing over these next years. In 2024, when the company reports its completed fiscal year earnings, they expect it will be 45 cents a share. Then they expect an increase to 55 cents a share, rising to 68 cents a share, 93 cents a share in 2027, and then $1.25 in 2028. So between 2024, 45 cents a share, to 2028 to $1.25 a share, Wall Street analysts expect this company's earnings per share to triple over these next 4 or 5 years. That's an excellent rate of increase. So now that we've looked at the company's financial metrics, business performance, profitability, cash flow, and expectations for the future, let's look at the valuation. And I'm measuring using the forward price to earnings ratio. And according to this metric, the stock is trading at a forward PE of 82, which is on the lower end of where the stock has traded for going back until early 2022. But a forward PE of 82 is about 4 times the price of the average stock in the S&P 500, which trades at a forward PE between 20 and 23. So you're paying a super premium price for this business. Now, I will admit this business deserves a premium price. It's growing rapidly, it's growing profitably, and it's already generating cash flow from operations to sales at 20% in these early stages of growth. And it's competing against a wounded rival in Starbucks, which is trying to get its act together. And while it's trying to figure things out, there's an opening for Dutch Bros to continue expanding, to continue taking market share. All that being said, do I think long-term investors should buy Dutch Bros stock at current valuations? My conclusion is no. The price premium for Dutch Bros stock is too much to warrant a buy rating according to my evaluation. I have the stock rated as a hold and a watch. So these are the kind of companies where I'll put on my watch list and I'll keep an eye on the price and I'll keep an eye on the performance, looking at the earnings per share. Because if the price stays the same, but earnings per share grow faster than expected, then that makes a stock a better investment because you're getting more in return, but you're paying the same price. Oftentimes, investors only look at the price and not look at the growth and profits to see what they're getting in return, right? It's like you go to a grocery store and you see one brand of soda, it's $2 for the 2-liter bottle. And then imagine tomorrow you go to the store and it's still $2 for the same brand, but now they introduced a new bottle. Instead of 2 liters, it's 3 liters and you're still paying $2. So now you're getting more for the same price that you're paying. That's kind of like looking at earnings with companies. If the price stays the same, but the profits increase, that's getting more for the same price that you're paying. And so that makes it a more attractive investment. And those opportunities open up more so than opportunities where the market price crashes, but the earnings stay the same. So that's what I'll be looking out for with Dutch Bros for now. I'll keep it rated as a hold. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.